So Melbourne's property market has quietly started to turn the corner. It's not booming, not even close, but the early signs are starting to show up. Prices have stabilized, auctions are getting busier, and lending's rising for the first time in years. Despite that, most people are still calling Melbourne dead money. But the data is telling a completely different story. Something is shifting beneath the surface. In this video, I'm going to show you exactly what's changing in the numbers, what areas are starting to pick up, and what this all means for 2026. And you'll want to stay right until the very end, because I'm going to be revealing the 4 key indicators that will move first when Melbourne's markets begin to rebound. And 2 of them are already flashing red hot right now. Guys, my name's Josh. I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit that like button. And with that said, let's jump straight into what's working in Melbourne's favor right now. So after 2 years of interest rate pain, Melbourne is finally getting some relief. The RBA has already cut 3 times this year, and the cash rate now sits at 3.6%. And that matters because with Melbourne's higher median house prices, even a small cut gives buyers more breathing room when it comes to negotiating with sellers. And you can already see it in the market on the ground, where auction clearance rates are up by 10% year on year, and buyer inquiry volumes are rising steadily. Now, whilst lower rates don't guarantee price growth, they remove the biggest barrier that was holding Melbourne back in the first place. And when credit gets cheaper, the first thing that turns is lending. And that's exactly what's beginning to happen right now. So credit momentum is definitely back in Victoria, and that shift in credit is now showing up in the data. For the first time in 2 years, lending in Victoria is increasing again. If we look at the most recent ABS data released in June 2025, we can see that owner-occupier lending is up by 5.2% versus same time last year. Investor lending is up by 8%, and first home buyer lending is up by 4.2%. Now, whilst that's not a surge, it's definitely a solid reversal. And at the same time, we're seeing banks ease their serviceability buffers and also sharpen their rates, particularly their fixed rates. And that always comes before an uptick in activity. For example, in previous cycles, 2012 and 2019, Melbourne prices started rising within 6 months of credit turning positive. So the money's definitely moving, but the real question is whether confidence is following. So whilst lending is definitely lifting, confidence has to follow for that momentum to last. And the signs are already emerging on the ground. And sure enough, we're starting to see it in the data. If we look at the Westpac Melbourne Institute House Price Expectations Index, it shows us that for Victoria, it's hit its highest levels since 2021. The index currently sits at 172. And we all know what happened during the pandemic when that indicator was last this high. House prices shot up. Now, at the same time, if we look at the Real Estate Institute of Victoria's auction clearance rates, they're averaging about 86% in the most recent week, and that's up from 75% a year ago. Vendor discounting, well, that's tightened to negative 3%. And that's effectively the discount that vendors are having to provide to buyers when selling their property. So whilst buyers aren't rushing in yet, they've definitely stopped waiting for things to get worse. And that exact mindset shift from fear to curiosity is where every Melbourne recovery begins. And once sentiment turns, capital doesn't just sit still. It moves to where the value is. We're now seeing early capital rotation back into Melbourne. Investors who made their gains in Perth and Adelaide are starting to look east again. Why, you might ask? Well, because Melbourne appears undervalued relative to its long-term trend. The best example of that is yields, where we're sitting at 3.7% now across the board, which is now higher than Brisbane, Sydney, and on par with Adelaide. Even more profound than that, the median dwelling gap between Melbourne and Sydney now sits at $436,000, which is massive. So that increased lending across the board, that isn't just speculative money, it's strategic capital positioning that's happening early. And if you want to see the rebound before the headlines do, well, Melbourne leaves clues in the data. And those clues, they're clearly visible and you can spot them in the leading indicators that always turn first. And with that said, here's what those key signals look like. There's 4 key indicators that move first. So firstly, sales volumes need to be rising quicker than new listings. Secondly, I'd want to see vendor discounting below 3%. Thirdly, rental vacancy rates would need to be at 1.5% and trending lower. And then lastly, days on market would need to be comfortably within 30 days. Now, Melbourne's already hitting number 1 and it's almost about to hit number 2 with vendor discounting in the most recent Cotality data at 3.1%. Vacancy rates are at about 1.8% and they're trending lower, which is tight for a city of Melbourne's size, but just above that 1.5% that I'd typically be looking for as that rebound signal. If it slips under 1.5% or even just stays at that level, that's a clear sign that demand is outpacing supply. And as for days on market, we're currently sitting at 35, which is above where I'd want to see it, and that's flat compared to last year. So there's no compression in days on market. But what's different this time is where the momentum is actually showing up. And that's where the data gets really interesting because the heat isn't where most people think it is. Now, if you want to see the exact framework that I use to filter out bad assets, make sure you grab my completely free property due diligence checklist in the description box down below. It shows you exactly how to spot red flags and other problems before you buy. And with that said, let's touch on where Melbourne's current momentum is coming from. Because this rebound, it isn't coming from the blue chip areas like in past cycles. Right now, it's the affordable areas that are leading the charge. You've got areas like Sunshine West, Derrimut, Frankston, and Carrum Downs that have already moved by over 10% in the last 12 months alone. And across Melbourne, there's over 130 suburbs that have recorded price growth in the last quarter. And even the more premium affluent areas like Toorak and Bolwyn have stabilized after years of declining prices. They've gone flat instead of sliding. And I'm just going to bring up this chart from Cotality that actually makes it obvious why you need to be super selective right now. You can see on this chart that the dark blue zones, areas like Melton, Preston, Pakenham, Healesville are up by 3 to 6% in just the last 3 months alone. Meanwhile, the orange and dark red patches around Bayside and the inner south are still moving backwards. So it's a genuine 2-speed market at the moment. Momentum in the value corridors and softness in parts of the premium belt. So this definitely isn't a buy anywhere and win type of territory. You have to be strategic and data driven if you're entering into Melbourne at this point in the cycle. But the key moment is going to be when these two fronts start converging together, because that's when Melbourne's broad-based upswing will actually take place. And when that happens, it lines up perfectly with Melbourne's long-term rhythm of growth. And if you want to see what the other side of that looks like, a market that's already hot across the board, watch my video on the Brisbane market summary for 2026. That city is the polar opposite to Melbourne right now. You've got tight stock across the board, bidding wars, and momentum absolutely everywhere. I'll link it on the screen and in the description box down below if you want to check it out. So lastly, let's touch on mean continuation. So over the past 10 years, Melbourne has averaged growth of between 5 to 6% per annum. And that's long-term trend. It's definitely not underperformance relative to the national long run average. It's not about catching up. The past few years have been materially below that. So this is simply about getting back to that normal momentum. It has nothing to do with catching up. And Melbourne's rebound is definitely going to be aided by the fact that building approvals remain well below 2021 highs. Rental listings are 27% lower than they were in 2022, and population in Victoria grew by 124,000 in the 12 months to March 2025. And that represented about 30% of the national population growth in the whole of Australia. And while those fundamentals don't guarantee price growth overnight, they do set the stage for steady price pressure in the short to medium term. So in other words, this isn't a speculative bounce. It's Melbourne returning to its own baseline of growth. Which brings us to where the city really stands right now. The groundwork phase before confidence and capital fully align. So with that said, has Melbourne rebounded? Well, not yet, but the groundwork's definitely being laid. Rates are easing, credit's expanding again, confidence is improving, and capital is quietly rolling back in. We're not in a boom, we're in the part that comes before the headlines. And that's exactly why watching the data matters, because by the time the media's called it a recovery, the smart money has already moved. And if you're still here watching, you're already doing what 99% of investors won't. You're tracking the shift as it happens, not after it's obvious to everyone. So definitely keep an eye on the numbers, question the noise, and I'll keep breaking it down for you every week. Guys, make sure you've subscribed if you haven't already so you can continue getting data-driven content just like this. Press the like button and I'll see you in the next one. Thanks so much for watching.